What if I told you the future of AI isn't just about clever algorithms or, powerful processors? What if it's actually about the fundamental materials engineering that builds those very chips? It's this critical, often invisible layer that underpins our entire digital world.
It's absolutely true. We tend to focus on the flashy end products, right? The supercomputers, the AI models. They seem almost magical. But the foundational work, the real enablers, they're often several steps back in the supply chain, kind of hidden from view.
And that's exactly why today we're taking a deep dive into applied materials, Inc., or AMAT. Now, this probably isn't a household name for most people, but it's absolutely crucial to the global technology landscape. They enable virtually every new chip being made.
Yeah, our analysis today is based on a really in-depth investment report. It's packed with insights into AMAT's operations, financials, their competitive landscape, future prospects, the works. Think of this as your shortcut to really understanding a cornerstone of the semiconductor industry.
Okay, so our mission for you, the listener, is to unpack why AMAT is such a critical enabler of this whole AI-driven semiconductor supercycle. We'll help you grasp its unique competitive advantages and, explore the risks and opportunities that are shaping its future. We want to go beyond the headlines, give you a truly informed perspective. Okay, let's unpack this. So, to start, the report positions applied materials as a linchpin, that's a strong word, a critical and indispensable enabler in the global semiconductor industry. Why is that term so fitting here?
Well, it's fitting because AMAT doesn't actually make the chips, the final things we use. Instead, they provide what are called materials engineering solutions. If you picture the inside of a microchip, it's like this incredibly complex 3D maze, tiny, tiny structures, incredibly thin layers. AMAT provides the super sophisticated tools and processes you need to actually build those layers. So depositing materials, etching them away, modifying them, all at an atomic scale. Without their technology, the most advanced chips, they just wouldn't be possible. They're really the hidden foundation.
The silent architects building the bedrock. Okay, and this isn't just about, general chip manufacturing. The report specifically links them to the AI-driven semiconductor supercycle. How does AMAT plug into that massive shift?
Right. So AI and machine learning, they're driving this absolutely unprecedented demand for computing performance and critically for energy efficiency too. This isn't just about making things a little bit faster. It's forcing a fundamental shift in chip design. We're talking about incredibly complex 3D architectures now, things like gate-all-around transistors, GAA, or next-generation 3D DRAM. These chips aren't just smaller versions of old ones. They need totally new ways to be built. That means new materials, dozens of new manufacturing steps, all needing incredible precision.
Oh, okay.
And that's exactly where AMAT's expertise becomes indispensable. Each of these big technological shifts directly increases the number and the complexity of manufacturing steps. And that significantly expands the total addressable market for AMAT's core equipment deposition, etch, process control, all that stuff.
I see. So as chips get more complex for AI, AMAT's role actually becomes even more central, more critical. The report also highlights their uniquely broad and integrated portfolio. How does this breadth translate into a competitive advantage? What's their moat here?
Yeah, that breadth is a huge advantage, and it's incredibly difficult for competitors to replicate. You see, many competitors might specialize in just one or maybe two process steps, but AMAT, they offer solutions across nearly all the major non-lithography stages of chip manufacturing. This means they can look at the entire manufacturing flow holistically. And when you're working at the atomic scale, how one step impacts the next one. That's absolutely crucial.
Right, it's all connected.
Exactly. So AMAT can deliver these co-optimized integrated solutions. Basically, they guarantee that each stage works seamlessly with the others. This makes their offering incredibly sticky for customers. It's not just about selling a standalone tool anymore. It's about providing a complete, optimized manufacturing recipe that's already proven to work.
A pre-validated recipe. That makes a lot of sense. It's not just the ingredients, it's the whole method. Guaranteed. Okay, let's take an initial look at their financials then. The report mentions remarkable resilience and strong profitability. What kind of financial picture does AMAT paint?
Well, they show really robust financial health. In fiscal 2024, for instance, AMAT generated over $7.4 billion in free cash flow. That's a significant number. And what's particularly telling is their commitment to shareholders. Over the past decade, they've returned nearly 90% of that free cash flow back to shareholders.
90%? Wow. How?
Through a combination of growing dividends and pretty substantial share repurchase programs. Their operating margins have also shown this structural improvement. They're consistently hovering near 30% now. And a key reason for this resilience and profitability, especially given how cyclical the industry can be, is their Applied Global Services segment, or AGS, that provides a really stable, highly profitable, recurring revenue stream. It's like a buffer.
Okay, so technological leadership backed by a really strong financial foundation. Beyond just the explosion of AI, what other key growth vectors are driving AMAT's trajectory?
Well, AI is definitely the primary engine, no doubt about that. But the demand for these AI chips is forcing specific technological shifts that directly benefit AMAT. We touched on the move to complex 3D architectures, right? The gate-all-around transistors, 3D DRAM. Plus, there's the increasing adoption of advanced packaging techniques like hybrid bonding.
Right.
Each of these is fundamentally a materials engineering challenge. They significantly increase the number and complexity of manufacturing steps involved. And that, again, directly expands the total addressable market for AMAT's core deposition, etch, and process control equipment. And as we just mentioned, the services business AGS provides that crucial, stable, high-margin growth vector. It just grows in lockstep with their ever-expanding installed base of equipment worldwide.
Okay, let's take that deeper now. The report breaks down AMAT's business into three distinct pillars, three segments, each contributing differently. Could you give us a quick overview of these segments before we dive into each one?
Sure. So Applied Materials operates primarily through three main groups. First, there's the Semiconductor Systems Group, or SSG. That's their core equipment business. Second is Applied Global Services, AGS, which provides all the support and services. And third is a smaller segment, Display and Adjacent Markets. Each plays a pretty distinct role in the company's overall ecosystem.
All right, let's start with that first pillar then. Semiconductor Systems Group, SSG. The report calls it the engine of applied materials. Why is it the engine? What exactly does it do?
SSG is definitely the engine. It's the largest contributor to their net revenue by far. And it's their primary interface with the technological bleeding edge of chip manufacturing. This is where AMAT develops, manufactures, and sells that incredibly sophisticated capital equipment used to actually fabricate semiconductor chips. It really is the innovation powerhouse, constantly pushing the boundaries of what's possible in materials science.
And what's inside that sophisticated portfolio? You mentioned front-end of line and back-end of line processes. Can you maybe elaborate on the types of tools they provide for those critical steps? Give us a sense of the sheer challenge involved.
Absolutely. The SSG portfolio is genuinely one of the most comprehensive in the entire industry. For the front end of line, that's where the individual transistors are actually formed on the silicon wafer. Think of it as literally building the chip atom by atom. They provide tools for deposition. That's layering materials onto the wafer with incredible precision, sometimes just a few atoms thick.
Just atoms thick.
Yeah. Then there's etch. That's like microscopically sculpting, selectively removing materials with extreme accuracy. They also do ion implantation. That's where they precisely dope the silicon with foreign atoms. It's like injecting tiny specific ingredients to give the transistors their electrical properties, their personality. It's an incredibly delicate process, crucial for chip performance. And then process control. That involves metrology and inspection tools to make sure everything is perfect, checking for defects at every single step to ensure you actually get working chips, good yield. For the back end of line, they're leaders in advanced packaging solutions. This isn't just about making the chip anymore. It's about connecting finished chips together in new ways to create more powerful and efficient systems, moving beyond that traditional 2D scaling.
Okay.
So this breadth allows AMAT to address the entire process, creating the transistors and the intricate wiring, the interconnects that link them all together.
That's just an astonishing level of precision required. And the revenue breakdown for this SSG segment, it really underscores their strategic alignment, doesn't it?
It really does. In fiscal 2024, the revenue mix for SSG was heavily weighted towards the most advanced sectors. Foundry, logic, and other related categories accounted for a hefty 68% of segment revenue. DRAM contributed 28%. Flash memory, or NAND, was a smaller piece at 4%.
So mostly the high-performance stuff.
Exactly. This breakdown clearly shows AMAT's deep entanglement with high-performance computing, AI, data center trends. All the areas fueling massive capital investments in leading-edge logic and memory right now. And this alignment with these really capital-intensive areas, it tends to enhance the quality and sort of predictability of their revenue stream. These investments are often less discretionary than, say, in more commoditized chip segments.
How did that translate into their recent financial performance for SSG? Any specific numbers?
Yeah, in the second quarter of fiscal 2025, SSG reported net revenue of $5.26 billion. What's particularly notable is their non-GAAP operating margin. It reached 36.4%.
36%, that's high.
It is. And it was up 150 basis points year over year, which clearly reflects that strong demand from those leading-edge customers pouring money into AI and advanced computing.
Okay, moving on to the second pillar. Applied Global Services, or AGS. This segment is described as a strategic flywheel and stabilizer. What does AGS actually do, and how does it play this crucial role?
Right. So AGS provides this comprehensive suite of solutions designed to basically optimize the performance and productivity of semiconductor and display factories, or fabs. This includes really essential services like providing spare parts, offering equipment upgrades, performing routine maintenance, and even supplying factory automation software. And all of this is for AMAT's incredibly vast installed base of equipment already out there in customer fabs.
So it services all the machines they've already sold.
Precisely. And the core of AGS is its recurring revenue stream. This acts as a really significant ballast, a stabilizer, against the inherent volatility of the equipment market, which can swing quite a bit. With such an enormous number of their systems already installed worldwide, AMAT has this, virtually captive market for services and spares.
And how sticky is that business? I mean,
Yeah.
are customers really locked in once they have AAT equipment running?
They really are. The company has successfully transitioned a large chunk of this business to long-term service agreements, and they boast renewal rates exceeding 90%.
Over 90%.
Yeah, it's incredibly high. And that renewal rate isn't just a number, it powerfully demonstrates how mission-critical AMAT support is, and it shows the significant switching costs involved if a customer tried to move to, say, a third-party provider. These are immensely complex machines, and customers rely heavily on AMAT's specialized expertise to keep them running optimally, maximizing their output.
So it offers fantastic stability. But you also called it a strategic flywheel. How does it go beyond just smoothing out revenue?
Well, it's vital in several strategic ways.
Mm-hmm.
For example, look at the 2019 industry downturn. Equipment sales, SSG sales, faltered significantly. But the AGS business, it actually achieved record financial results that year.
Really? During a downturn?
Yes, it powerfully showcased its counter-cyclical strength. And this stability is crucial because it allows AMAT to keep investing heavily in R&D even when the market is down. That's absolutely critical for maintaining their technological lead over competitors who might be forced to pull back on R&D spending during tough times.
That's a massive competitive edge, being able to invest continuously no matter the cycle.
It's huge. And there's another critical aspect. The deep ongoing presence of AGS engineers inside customer fabs creates this invaluable real-time feedback loop.
Oh.
These engineers are on the ground. They see exactly how the tools perform in real-world production. They identify yield challenges, understand emerging customer needs firsthand. This direct intelligence is critical because it feeds back into and informs the R&D priorities of the much larger SSG segment.
I see. So it's a loop.
Exactly. It's the symbiotic relationship. The installed equipment base feeds the service business, and the service business provides the intelligence to design even better equipment. It creates a really powerful, self-reinforcing competitive advantage. Management has even expressed confidence in achieving a low double-digit annualized growth rate for core services over the long term because of this dynamic.
That feedback loop must be absolutely invaluable for staying ahead. And what of the recent financial performance of AGS? Stable and profitable.
Very much so. AGS is characterized by stable revenue growth and consistently high operating margins. Often, its margins exceed even those of the SSG segment. In Q2 2025, for example, AGS posted revenue of $1.57 billion with a non-GAAP operating margin of 28.5%. This consistent profitability is a key contributor to AMAT's overall financial strength and resilience. It really acts as a true anchor for the business.
Okay, now for the third and somewhat smaller pillar. Display and adjacent markets. What exactly does this segment cover, and what are its market dynamics like?
Right, so this segment primarily provides equipment for manufacturing things like liquid crystal displays, LCDs, and organic light-emitting diodes, OLEDs, plus other display technologies used in, TVs, monitors, smartphones, all that stuff. However, this market is generally smaller and, frankly, much more volatile than the semiconductor market. It's subject to its own distinct capital expenditure cycles, which are mostly driven by consumer demand for new display technologies and form factors. Think flexible screens, foldable phones, that kind of thing.
So a bit more of a niche player in this area and subject to sharper ups and downs depending on consumer tech trends.
Yeah.
How did that volatility show up in its recent financial performance?
Yeah, you can clearly see the volatility in its financial results. Its contribution to AMAT's total revenue is the smallest of the three segments, and its operating margins can fluctuate pretty dramatically. For instance, in Q2 2025, the display segment's operating margin was actually quite strong at 26.3%.
Okay.
However, that was a massive improvement from just 2.8% in the same quarter a year prior. So that really highlights its inherently cyclical nature, big swings.
Definitely. So to summarize this section on the business segments, it sounds like AMAT has this really central and commanding position within the whole semiconductor manufacturing value chain. What does that mean for their customer relationships and their exposure to different end markets?
It means they are truly foundational. AMAT provides the core tools and processes that literally transform raw silicon wafers into these incredibly complex integrated circuits. Their equipment is absolutely essential for the front-end fabrication process, where the transistors and interconnects are actually created. Their influence is so pervasive that their technology is used to produce virtually every new chip and advanced display in the world. It really places them right at the heart of the industry's technological progress.
And who are these customers they're working so closely with? Is it just anyone building a fab?
Not at all. Their customer base spans the entire semiconductor ecosystem. We're talking pure-play foundries like TSMC, integrated device manufacturers or IDMs like Intel, and the major memory manufacturers like Micron. And these aren't just transactional buy-sell relationships. They are deep collaborative partnerships, often spanning decades.
Decades, okay.
These relationships are critical because the immense cost and technical complexity of qualifying manufacturing equipment create really significant customer stickiness. Once a chip maker commits to a certain process recipe using AMAT's tools, it's very, very difficult and prohibitively expensive to switch horses midstream.
Right, that requalification process sounds like a nightmare.
Exactly. And finally, how does all this translate into their exposure to the broader electronics market?
Yeah, how does that work?
Well, through these deep customer relationships, Applied Materials gets broad exposure to the full spectrum of high-growth electronics end markets. The chips made with AMAT's equipment are the foundational building blocks for AI, obviously, but also data center servers, smartphones, automotive electronics, the Internet of Things, industrial applications, you name it. This vast diversification provides a great deal of resilience and ensures the company is positioned to benefit from multiple concurrent secular growth trends that are fundamentally reshaping the global economy.
Okay, let's zoom out now and talk about the wider stage. The semiconductor equipment industry, often called wafer fab equipment or WFE. The report describes it as a classic oligopoly. First, can you define the scale of this industry and its growth trajectory? What are we looking at here?
Sure. The WFE industry is incredibly sophisticated, massively capital intensive, and frankly, strategically vital on a global scale. It's a huge market, with annual sales now exceeding $100 billion.
Wow, over $100 billion a year.
Yeah. And looking ahead, market research firms project a really healthy long-term growth trajectory. Consensus estimates point to a compound annual growth rate, or CAGR, of somewhere between 7% and 9.5% through 2030 and likely beyond. And importantly, this isn't just, cyclical growth hoping for a good year. It's underpinned by incredibly powerful non-cyclical demand drivers.
What are those core drivers? What's really pushing this sustained growth in the long term beyond just the ups and downs?
Well, it's the relentless expansion of data, first and foremost. Then there's the global build-out of 5G networks, the proliferation of IoT devices everywhere, the rapid electrification and increasing autonomy of vehicles, and perhaps most importantly, the truly transformative rise of AI. All of these massive forces are converging to create this unprecedented, almost insatiable demand for more powerful, more efficient, and more specialized semiconductors.
So back to that oligopoly description. You said it's dominated by a few players. Who are the key players, and what makes it so incredibly difficult for new companies to break into this market?
Yeah, the WFE market is indeed a classic oligopoly. It's dominated by a small handful of highly specialized firms. The 5 key players that control most of it are Applied Materials, ASML, Lam Research, Tokyo Electron, and KLA. Collectively, these companies command a significant majority of the global market share.
And the barriers to entry?
Immensely high. We're talking about just enormous and constantly escalating costs of research and development. Developing a single new system can cost hundreds of millions, even billions of dollars. Then there's the need for extensive and defensible patent portfolios. You need serious IP protection. And maybe most importantly, those deep collaborative relationships with chip makers that, as we said, take decades to build trust and integrate with. The technical expertise and the sheer capital required to compete at the leading edge make it virtually impossible for new entrants to just jump in.
Okay, that makes sense. And you mentioned AI is a major catalyst again. How is it specifically impacting the WFE industry and driving these mega trends that seem to benefit AMAT so much?
AI is arguably the single most important catalyst right now because it necessitates radical changes in chip architecture. The industry is rapidly moving away from traditional transistor designs towards things like gate-all-around or GAA structures, and there's a clear roadmap towards backside power delivery and next-gen 3D DRAM.
So really fundamental shifts in how chips are built.
Exactly. These aren't just incremental tweaks. They require entirely new materials and dozens of new, incredibly precise manufacturing steps. This directly increases what we call process intensity, especially for deposition and etch steps, which, remember, are AMAT's core areas of strength. Consequently, the industry's transition to more advanced manufacturing nodes like 3 nanometers and 2 nanometers powerfully drives WFE's spending. Each new node demands a new generation of more capable and, frankly, more expensive equipment.
That really drives home how foundational these companies are to technological progress. Now, the semiconductor industry has always been known for its, let's say, dramatic cyclicality, those boom and bust periods. But the report suggests there's emerging evidence that this historical pattern might be broken. What does that mean? Is the cycle really dead? And what are the implications?
Right. Historically, the industry has definitely experienced this roughly 4-year cycle of boom and bust. There have been something like 13 distinct recessive periods just since 1963. These were often driven by a mismatch between capital investment and end market demand, often tied to consumer electronic cycles like PC upgrades or new smartphone generations. The memory chip market was traditionally the most volatile segment.
Okay, so what's different now?
Well, what we're seeing now, or what the analysis suggests, is unique. The current upswing in WFE spending, particularly at the leading edge, isn't really being driven by a broad-based increase in consumer unit volumes. It's not like everyone is suddenly buying way more phones or PCs, creating demand across the board.
Interesting. So where is the demand coming from?
Instead, it appears to be a highly concentrated, profit-driven build-out of infrastructure for essentially a single transformative application: artificial intelligence. This demand is coming predominantly from a very small number of hyperscale data center operators, think the big cloud providers and the AI chip designers themselves, like NVIDIA. This has created a sort of bifurcated market. Demand for leading-edge equipment, particularly for AI logic and memory, is incredibly strong. Yet at the same time, overall fab utilization rates for some major players, like TSMC, have actually remained below peak levels in some of their other segments.
So the AI part is booming, but maybe other parts aren't as much.
Exactly. It suggests the primary driver of WFE spending, at least at the high end, is shifting away from just sheer unit volume towards technological complexity and capital intensity.
So the value of each individual wafer and the cost of the equipment needed to produce it is going up dramatically, even if the total number of wafers produced isn't growing quite as fast across the board. What are the profound implications of this potential broken cycle for AMAT and for investors thinking about this space?
Well, this new dynamic has potentially significant implications. The strategic multi-year nature of these massive AI infrastructure buildouts might prove to be more resilient and less susceptible to short-term fluctuations in consumer sentiment compared to past cycles. This could potentially dampen the amplitude, the highs and lows of future cycles for companies like AMAT that are heavily exposed to that leading edge.
So maybe less volatility.
Possibly, at least for the top end. The critical insight for investors might be that the old rule of waiting for a broad consumer electronics rebound to drive WFE spending might no longer fully apply, especially for the leading-edge equipment makers. The primary driver now seems to be technological evolution and the strategic imperative of AI. However, there's a flip side. This also increases customer concentration risk. It ties the company's fortunes even more tightly to the capital expenditure plans of a smaller, albeit very powerful, set of end customers.
Fascinating dynamic. Okay, let's talk about the battle of titans in this competitive landscape. We know AMAT is a major player, one of the big five. Who are the other giants, and what's each company's unique strength in this oligopoly?
Right. As you said, the WFE market is dominated by these 5 global titans, and each really has a distinct area of strength and strategic focus. It's not like they all do exactly the same thing.
Let's start with Applied Materials itself again. We talked about their breadth. How does that define their competitive advantage compared to the others?
AMAT is often described as the broadline supplier, and that's really its defining advantage, the sheer breadth of its product portfolio. They are, as far as we know, the only company with a really strong market position across nearly all the major non-lithography process steps. So that includes deposition, etch, ion implantation, and process control. This allows AMAT to pursue that strategy of offering integrated solutions, co-optimizing multiple process steps together on a single platform. They hold a dominant market share in deposition and are a top-tier competitor in etch, making them a formidable presence across the chip-making process. Their overall WFE market share was estimated around 20% in 2023.
Okay. And then there's ASML, the Dutch giant. They seem to be in a league of their own in one specific area.
They absolutely are. ASML holds what amounts to an absolute monopoly in the market for extreme ultraviolet or EUV lithography systems. These EUV machines are indispensable for manufacturing chips at the most advanced nodes, like 3 nanometers and below. Lithography is the single most critical and by far the most expensive step in the chip-making process. It's basically printing the intricate patterns onto the wafer.
So they control a key bottleneck.
Precisely. ASML's unique position gives it immense pricing power and makes it a strategic choke point in the global semiconductor supply chain. Their market share is even higher, around 24%. Now, AMAT doesn't compete directly with ASML in lithography, but they provide essential enabling technologies like deposition and etch systems that are used in conjunction with ASML's tools to actually build those highly complex chip structures.
Okay, so they're complementary, not direct competitors there.
Yeah.
Who is AMAT's most direct competitor in their core areas like deposition and etch?
That would definitely be Lam Research, or LRCX. Lam is more of a specialist with a primary focus on the etch and deposition markets, where it holds very strong leadership positions alongside AMAT. Lam has historically been particularly strong in the memory segment, with deep expertise in complex 3D etch processes needed for 3D NAND flash memory, and also deposition techniques for DRAM. Lam's strategy is really to leverage its best-in-class product performance in specific areas to gain market share at key technology inflections, directly challenging AMAT in its core markets. Their share is around 11%.
Okay, a head-to-head rival. And what about KLA Corporation? Where do they fit in?
KLA, or KLAC, is the undisputed leader in the process control market. This encompasses all the inspection and metrology tools used to detect defects and ensure chips are manufactured to incredibly precise specifications. As chip features shrink and complexity grows, process control becomes ever more critical for achieving acceptable manufacturing yields. If you can't measure it, you can't make it reliably. KLA's dominance in this specialized domain is reflected in its market share, which exceeds 50%. A smaller overall share of WFE, around 7%, but dominant in their niche.
50%. Wow. Okay. And finally, Tokyo Electron.
Tokyo Electron, or TLL, is another major competitor, particularly strong in Asia, challenging both AMAT and Lam Research. They possess a strong and diversified portfolio that includes leading positions in deposition, etch, and also things like wafer bonding equipment. Their market share is roughly around 9%.
It sounds like a brutal but highly specialized competitive environment. You mentioned earlier that the competition is increasingly about the ability to solve integrated problems.
Yeah.
How does AMAT's broadline approach become a strategic weapon in this context, giving them an edge?
Yeah, that's where AMAT's breadth truly starts to shine and becomes more than just having a lot of products. As manufacturing challenges get more complex, the interaction between different process steps becomes absolutely paramount. For example, how a film deposited in one step behaves during a subsequent etch step can determine success or failure.
Right. The steps aren't isolated.
Not at all. So AMAT can leverage its deep expertise across multiple domains, deposition, etch, metrology, etc., to develop these integrated solutions that a more specialized competitor simply cannot easily replicate. A prime example the report cites is their integrated hybrid bonding solution. This system combines something like 6 distinct technologies: deposition, cleaning, metrology, bonding, all into a single co-optimized platform. This capability to sell a pre-validated manufacturing recipe rather than just a standalone tool creates that powerful moat we talked about. It increases switching costs significantly, and it allows AMAT to capture a greater share of the total value created on each wafer processed. It's about selling certainty and optimized performance for a whole sequence, not just individual components.
That deep integration capability sounds like a very powerful differentiator. Okay, let's shift gears now and look at AMAT's financial pulse over the last decade or so, say from fiscal 2015 to 2024. What does that period tell us about their revenue growth and overall trajectory?
Well, the company's revenue trajectory over that decade has been pretty impressive. Their revenue grew from about $9.7 billion in fiscal 2015 to over $27 billion in fiscal 2024. That represents a compound annual growth rate of roughly 12.2%. So strong double-digit growth over a decade.
But it wasn't a straight line up, I assume, given the cycles.
Oh, definitely not linear. It clearly reflects the industry's cyclical nature. For example, we saw a significant acceleration, like 34% year-over-year growth in 2021, which was fueled by that huge post-pandemic surge in electronics demand. But then you also had a notable downturn in fiscal 2019 when revenue actually contracted by about 12.5%, mainly due to a slowdown in memory and display spending that year.
So even with those cycles, the overall trend is strongly upward. What about operating margins? That's a key indicator of profitability. How have they trended?
Absolutely. And a really key feature of AMAT's performance over this period has been the structural expansion of its operating margins. They've improved dramatically, moving from around 17.5% back in fiscal 2015 to a sustained level near 29-30% in recent years.
That's a big jump in underlying profitability. What drove that?
It's attributable to several factors working together. Greater operational efficiency, certainly. Improved pricing power, driven by their technological leadership in key areas. And also, importantly, a favorable product mix that's increasingly skewed towards that high-value, leading-edge equipment we talked about, and, of course, the high-margin AGS services segment playing a bigger role.
And how has that strong revenue growth and margin expansion translated into free cash flow generation? That's often seen as the real measure of a company's financial health, right? Where the rubber meets the road.
It's been exceptional, frankly. Their free cash flow, or FCF, has grown dramatically. It went from just under $1 billion back in 2015 to nearly $7.5 billion in 2024. This robust and growing stream of free cash flow is really the cornerstone of the company's financial strength. It provides the foundation for those substantial capital return programs we mentioned earlier, the dividends and buybacks.
That's a massive increase in cash generation.
It is. And what's particularly interesting, according to the analysis, is a noticeable step change in FCF generation observed since around 2020. This suggests a fundamental improvement in the company's underlying business model. And it coincides with that period when chip complexity began to accelerate dramatically, driven by the move to 3D architectures for things like NAND and now logic. It indicates that the increasing technological intensity of the industry hasn't just boosted revenue, it has structurally lifted AMAT's margin profile and its ability to convert those earnings into actual cash. Their financial model seems much more powerful than it was in previous cycles.
That's a huge potential shift in their underlying business model resilience. And speaking of cycles, that 2019 downturn was a real stress test for the entire industry. How did AMAT navigate that period, and what does it tell us about their resilience now compared to, say, earlier downturns?
Yeah, the 2019 downturn was sharp. Global semiconductor sales declined by over 12%, led by a really severe contraction in the memory market. Applied Materials wasn't immune, obviously. Their fiscal 2019 revenue fell about 13%, and their non-GAAP operating margin contracted down to around 23.5%. However, and this is the key point, the company's performance during this period demonstrated a marked improvement in resilience compared to previous downturns. Management actually highlighted back then that the earnings per share in every single quarter of fiscal 2019 exceeded the total earnings for the entire fiscal year of 2013, which was the last significant downturn the industry faced.
Wow, so even in a down year, quarterly earnings beat the full year from the previous downturn. That's quite a difference. What was the critical factor in that improved performance?
A critical factor, maybe the critical factor, was the Applied Global Services, or AGS, segment. Remember the stabilizer. It achieved record revenue and record profits in 2019, even as the equipment sales were faltering. The stable, high-margin, recurring revenue from AGS acted as this powerful shock absorber, significantly mitigating the impact of the sharp decline in equipment sales.
So AGS really proved its worth then?
Absolutely. And this performance provides a clear blueprint for the company's likely through-cycle financial profile going forward. It suggests that as the installed base of AMAT tools continues to grow globally, the stabilizing effect of the AGS business will become even more pronounced, potentially reducing future earnings volatility even further.
That makes perfect sense. How about their working capital management? The report mentioned some fluctuations there depending on the market.
Yes, like any large manufacturer, AMAT's working capital levels do fluctuate with the business cycle and, importantly, supply chain dynamics. For example, during that period of really high demand and significant supply chain constraints back in fiscal 2022, both their inventory levels and their accounts receivable balances grew notably. Their days sales outstanding, or DSO, which measures how quickly they collect payments, increased from 74 to 82 days.
So things stretched out a bit then.
They did. But in contrast, by fiscal 2024, as supply chains started to normalize somewhat, inventory levels actually decreased from $5.7 billion down to $5.4 billion, and their DSO improved significantly back down to 68 days. This indicates more efficient working capital management and an ability to adapt as conditions change.
Okay, so they're actively managing that. And finally, on the financials, what does their balance sheet look like overall? How strong and flexible is it?
AMAT maintains a very strong and flexible balance sheet. This is crucial for navigating those industry cycles we keep talking about, and also for funding strategic growth initiatives like new R&D facilities or acquisitions. As of the end of fiscal 2024, their total debt was approximately $6.3 billion. That sounds like a lot, but it was against nearly $19 billion in stockholders' equity. That results in a pretty conservative debt-to-equity ratio of just 0.33. And notably, their long-term debt levels have remained remarkably stable over the years, indicating prudent financial management, not excessive borrowing.
And how well can they actually cover the interest payments on that debt?
Extremely well. Their ability to service their debt is exceptionally strong. The interest coverage ratio, that's basically operating earnings divided by interest expense, stands at a very robust 31.4x.
31 times?
Yes. It means their operating earnings cover their interest payments more than 31 times over. This signifies a very, very low risk of financial distress related to its debt obligations. Furthermore, they maintain a very strong liquidity position. They had over $8 billion in cash equivalents, and restricted cash at the end of fiscal 2024. Plus, they have access to an undrawn $1.5 billion revolving credit facility. All this ensures they have ample financial flexibility to seize opportunities or comfortably weather any potential downturns.
Okay, so a strong balance sheet, providing a solid foundation. With that in mind, let's look to the future now. What are the key growth drivers and strategic opportunities Applied Materials is actively pursuing to stay at the forefront of this incredibly fast-moving industry?
Well, their future growth is fundamentally predicated on their ability to enable the semiconductor industry's most critical and complex technological transitions. It all comes back to that. Their strategy really focuses on deepening their technological leadership, expanding their addressable market through continuous innovation, and leveraging their unique collaborative R&D model, which we should talk more about.
Innovation is clearly their lifeblood, as you said. How committed are they really to R&D, and what kind of investment are we talking about here? Is it significant?
Oh, innovation is absolutely paramount in the WFE industry. You can't survive without it. And AMAT's commitment to R&D is truly a cornerstone of its competitive advantage. They consistently reinvest a substantial portion of their revenue back into R&D year after year. In fiscal 2024, for instance, their R&D expenses totaled over $3.2 billion.
$3.2 billion just on R&D.
Just on R&D. And that represented approximately 11.8% of their net sales that year. This sustained level of investment, crucially maintained even through industry cycles, allows AMAT to simply outspend many smaller rivals and maintain that crucial technological edge across its broad product portfolio.
And a central pillar of this R&D strategy you mentioned is their new EPIC R&D Center. That sounds like it could be a real game changer. What exactly is it, and how is it designed to deepen customer lock-in?
Yeah, the Equipment and Process Innovation and Commercialization Center, EPIC in Silicon Valley, is a landmark investment for them. It's really a central pillar of their innovation strategy going forward. It's slated to come online in 2026, and it's designed to be essentially the world's most advanced collaborative R&D platform specifically for semiconductor manufacturing technology.
So more than just their own labs.
Exactly. Its strategic purpose is to fundamentally re-engineer the industry's traditional R&D model. How? By providing dedicated space within the EPIC Center for their chipmaker customers to come in and access and collaborate on next-generation tools years before those tools could even be installed in their own high-volume fabs. This aims to significantly reduce the time and the enormous cost of bringing new chip technologies from concept to commercialization.
And the lock-in effect.
That's where the collaborative model comes in. By co-developing entire process flows with their customers, using AMAT's own integrated ecosystem of tools right there in EPIC, AMAT can effectively pre-validate its platforms for the next wave of technology. So, when a complex new architecture, like say backside power delivery, is finally ready for mass production, the manufacturing recipe for it will have already been optimized on AMAT systems through this joint effort. This makes it exceedingly difficult, maybe even impossible, for a customer to then substitute a critical tool from a competitor into that validated flow.
That's a brilliant strategy. You're not just selling the tool, you're selling the pre-approved, co-developed process. You basically become part of their R&D.
In a way, yes. It creates a much deeper partnership and reliance.
And what are the key technology inflections that AMAT's management is focusing their R&D firepower on right now, specifically driven by AI's demands?
Management has been very clear about this. Their R&D focus is squarely on the industry's most critical technology inflections, and almost all of them trace back to the insatiable demands of AI. These include that transition to gate-all-around transistors, GAA we mentioned, the implementation of backside power delivery networks, a totally new way to get power to the transistors, the development of next-generation 3D DRAM for much higher memory bandwidth, and the continued advancement of advanced packaging technologies, especially things like hybrid bonding to connect chiplets together.
And these all play to AMAT's strengths.
Absolutely. Every single one of these transitions is fundamentally a materials engineering challenge at its core. They play directly to AMAT's core competencies in deposition, etch, modification, and control. And crucially for growth, each of these complex new technologies significantly increases the company's total addressable market, or TAM, because they require more and more advanced manufacturing steps.
Okay, so their core strengths are perfectly aligned with these huge upcoming shifts. Beyond the growth in their traditional WFE market, what other TAM expansion opportunities are they actively pursuing? Where else can they grow?
One major area they're focusing on is advanced packaging. As the benefits of traditional 2D Moore's law scaling, just shrinking transistors, start to diminish, advanced packaging and what's called heterogeneous integration have become absolutely critical levers for improving chip performance, power consumption, and cost.
So connecting chips together more cleverly.
Exactly. Stacking them, connecting them side by side with incredibly dense connections. AMAT is a key enabler here. They have a leading portfolio of solutions for things like through silicon vias or TSVs for vertical connections, and also for hybrid bonding, which allows direct copper-to-copper connections between chips or wafers. Plus, they're working on advanced substrates, the base layer everything sits on.
Is this a significant business for them already?
It's growing very rapidly. The report mentions projections for their advanced packaging-related revenue to increase from over $500 million in 2024 to potentially more than $850 million in 2025. That's very fast growth. Furthermore, AMAT made a strategic investment in a company called BE Semiconductor Industries, which is a leader in hybrid bonding assembly equipment. And they're doing work on large-format glass core substrates. All this signals a forward-looking strategy to provide solutions across the entire advanced packaging value chain, really blurring the lines between traditional front-end chip making and back-end assembly and test.
That's a significant expansion of scope. What about the ICPS market? That sounds like an acronym.
It is. While all the buzz is around leading-edge AI chips, the ICPS market, which stands for IoT, communications, automotive, power, and sensors, is also huge. This market serves chips built on more mature and specialized process nodes, not always the absolute cutting edge. It represents a large, diverse, and actually growing segment of the industry. These customers often have different requirements, maybe more focus on cost or specific reliability needs for automotive. AMAT has a dedicated product pipeline and strategy specifically to serve these ICPS customers, providing another important layer of diversification beyond just the bleeding-edge logic and memory.
Okay, that makes sense. And how about China, given the geopolitical landscape we discussed? Is that still seen as an opportunity, or is it mostly a risk factor now?
It's definitely both a complex situation. Despite the significant challenges posed by those U.S. export controls, China absolutely remains a substantial market for applied materials, particularly for the ICPS segment we just talked about, but also for DRAM memory and trailing-edge logic technologies where the restrictions are generally less severe than for the most advanced logic chips. Management has indicated publicly an expectation that revenue from domestic Chinese customers will likely normalize somewhere in the mid-20s as a percentage of their total revenue. So while navigating complex regulations, it still represents a significant ongoing business opportunity for them.
Mid-20% is still pretty substantial.
Okay.
And we can't forget about AGS, the services segment. What's its growth potential looking like for the future? Is it just tied to past sales?
The growth of the AGS segment is indeed directly linked to the expansion of AMAT's installed base of equipment. That's the core driver. Every single tool sold by the SSG segment represents essentially a future annuity stream of high-margin revenue for AGS through service contracts, spare parts, upgrades, software, etc.
And does the value of that service contract go up?
Yes, generally. As the equipment sold becomes more technologically advanced and, frankly, much more expensive, the value and complexity of the associated service contracts also tend to increase. You need more sophisticated support for a more sophisticated machine. So this creates this long tail of predictable, recurring revenue that grows almost naturally in lockstep with the company's success in the primary equipment market. It acts as a built-in, long-term growth driver for the whole company.
Okay, so they have a lot of strategic opportunities, clear growth drivers, and that stable base from services. Let's talk more explicitly about what makes them so strong against competitors, their moat builders, as the report calls them. It mentions that rating agencies like Morningstar and Guru Focus give AMAT a wide moat rating. What are the key pillars supporting this economic moat? What protects their profitability?
Yeah, that wide moat rating is significant. And the company's moat is indeed built on several reinforcing pillars that create these sustainable competitive advantages. The primary source, really the foundation of AMAT's competitive edge, is its deep and expanding technological leadership in materials engineering. And this is built upon significant intangible assets.
What kind of intangible assets are we talking about here beyond just skilled people?
Well, primarily their vast and truly formidable intellectual property portfolio, their patent library is huge. The report notes they added over 8,500 new patents just since 2013.
8,500.
Yeah.
That's an incredible pace of innovation.
It really is. This consistent and heavy investment in R&D creates a significant technological gap that smaller or less broadly focused competitors find exceedingly difficult to bridge. Furthermore, this technological prowess translates into a powerful data advantage. Think about it. With their equipment involved in nearly every key process step inside a cutting-edge fab, AMAT has access to an unparalleled volume and variety of data on how different materials and processes interact at the atomic level across the entire flow.
Ah, they see how everything connects in real-world manufacturing.
Exactly. Analyzing this massive data set provides unique insights into solving complex, multi-step integration challenges that might stump a competitor focused on just one area. This accelerates their own R&D and creates this kind of self-reinforcing loop of innovation. More data leads to better tools, which generate more data.
That data advantage sounds huge in this field. What about switching costs? We touched on this, but how hard is it really for a chipmaker to swap out AMAT's equipment once it's embedded in their production line?
It's incredibly difficult, leading to very, very high switching costs for customers. Semiconductor manufacturing is arguably one of the most complex and precise industrial processes ever devised by humans. Chip makers invest literally billions of dollars in years of intense engineering effort to develop and qualify a specific process recipe, the exact sequence of steps for manufacturing a new chip design.
Right, that's their secret sauce.
It is. So once a process flow is established and qualified using applied materials equipment for critical steps, the costs, the time, and the risks involved in trying to switch to a competitor's tool are often prohibitive. A switch would necessitate a lengthy and extremely expensive requalification process for that part of the line, or maybe the whole line. It could delay a new product's time to market by months, even years, and critically, it risks causing a decrease in manufacturing yield, making fewer good chips per wafer, which could cost a major chip maker hundreds of millions of dollars very quickly.
So the risk of messing up a working process is just too high.
For the most part, yes. This dynamic creates an extremely sticky customer base and a powerful lock-in effect for AMAT's installed base of equipment, especially for those crucial, hard-to-replicate steps.
So once you're in, you're really in for that process node or technology generation.
Yeah.
What about scale advantages? How does just being big play into their competitive edge?
AMAT definitely benefits from significant economies of scale across the board in R&D, in manufacturing, and in its global service operations. Its sheer ability to consistently outspend most competitors on R&D year after year has been a key factor in maintaining its technological lead across such a broad portfolio. Their global manufacturing footprint also provides flexibility and cost advantages. And, crucially, its worldwide service network, the foundation of that AGS business, is a massive competitive advantage in itself. This network provides that vital 24/7 support to customer fabs literally anywhere in the world. That's essential for maintaining the high uptime required for continuous, profitable chip production. A new entrant simply could not replicate this extensive and highly skilled global infrastructure without decades of investment and experience.
Decades. Okay. And finally, the report mentions a concept called efficient scale. What does that mean in this specific context, and how does it act as a barrier to new competition?
Right. Efficient scale helps explain why the WFE market is structurally a natural oligopoly. The core idea is that the sheer capital investment and the ongoing R&D spending required to compete effectively at the leading edge of semiconductor technology are so immense that the market can only profitably support a few very large players.
There's just not enough profit to go around for lots of companies doing the same thing at that cost level.
Exactly. The cost of developing just a single next-generation etch or deposition system or a new metrology platform can run into the hundreds of millions, sometimes even billions of dollars. This creates a massive structural barrier to entry that is nearly insurmountable for potential new competitors trying to break into the high end. It effectively protects the profitability and market position of the established incumbents like Applied Materials, ASML, Lam, KLA, and TILA.
Okay, so it sounds like a pretty well-defended fortress, which is great for the companies inside. But of course, every company faces risks, even the strongest ones. What are the key headwinds and challenges that AMAT needs to navigate successfully in the coming years?
Yeah, despite its formidable market position and that wide moat, AMAT is certainly exposed to significant risks. The most fundamental one, which we keep circling back to, is the inherent cyclicality of the semiconductor industry itself. Although the long-term secular growth trends look very favorable, the industry is still subject to periods of supply and demand imbalance, and these can lead to sharp fluctuations in customer capital expenditures. So, a significant downturn in end market demand, say a global recession, or maybe an overbuild of manufacturing capacity by the chip makers themselves, could cause them to suddenly delay or even cancel equipment orders. That would directly and materially impact AMAT's revenue and profitability, especially in the large SSG segment.
We've talked about AGS acting as a buffer, but it can't completely eliminate that cyclical risk, can it?
No, definitely not completely. While the resilient services business can certainly buffer some of that impact, soften the blow, the much larger equipment-focused segment remains highly exposed to these cyclical forces. The magnitude and duration of the next potential down cycle is always a key uncertainty for investors in this space.
And perhaps the most acute and complex risk right now seems to be around geopolitical tensions, especially concerning China. What are the specific risks there for AMAT that the report highlights?
Yeah, this is a major one. The U.S. government has implemented a series of increasingly stringent export controls over the past few years. These restrict the sale of certain advanced semiconductor equipment and related technology to specific Chinese entities. These regulations have already had a tangible negative impact on AMAT's revenue, according to their own statements, and they have definitely reduced the company's total addressable market in a region that was previously a major source of growth. Plus, the rules themselves are incredibly complex, they're constantly subject to change and reinterpretation, and this creates significant operational and compliance challenges for the company. Just figuring out what's allowed and what isn't is tough.
And there are direct legal implications too, aren't there? Investigations.
Yes, that's a serious aspect. AMAT has disclosed in its filings that it has received multiple subpoenas from various U.S. government agencies, including the Department of Justice and the SEC, requesting information related to its shipments to Chinese customers over several years. The outcome of these ongoing investigations is currently uncertain, but they could potentially result in significant fines, penalties, or even further business restrictions, creating a cloud of legal and reputational risk over the company.
And kind of paradoxically, these restrictions aimed at slowing China's progress could actually end up fostering new competition within China in the long run.
That's a very real and significant long-term potential consequence, yes. By restricting access to the most advanced tools from global leaders like AMAT, the U.S. government is, perhaps inadvertently, accelerating China's massive efforts to build a self-sufficient domestic semiconductor equipment industry. This effectively creates a kind of protected market, particularly on mature process nodes where restrictions are less tight, for emerging Chinese equipment manufacturers to develop their capabilities and gain experience. While these domestic Chinese players may not compete head-to-head at the absolute leading edge today, they could certainly emerge as formidable long-term competitors, especially within the large and growing Chinese domestic market itself.
That's a really complex dynamic with potentially unintended consequences. Okay, beyond geopolitics, what about more traditional competitive threats from their established rivals and the risk of customer concentration?
Right. Even without new entrants, the WFE industry is intensely competitive among the existing titans. AMAT faces highly capable and well-funded competitors like Lam Research and Tokyo Electron in those critical etch and deposition markets, which are core to AMAT's business. The pace of technological change is just relentless. So there's always a constant risk that a competitor could develop a disruptive new technology or a better mousetrap product that leapfrogs AMAT's current offerings in a key area, potentially leading to market share loss.
And the customer concentration.
Yes, that's definitely a risk factor too. The chip-making industry itself is highly concentrated. A very small number of extremely large companies, think TSMC, Samsung, Intel, maybe Micron, account for a disproportionately large share of global WFE spending each year. Therefore, the loss of or even just a significant reduction in spending from any one of these key customers would likely have a material adverse effect on Applied Materials' financial results. They're heavily reliant on the spending plans of just a few huge companies.
Okay. And finally, what about supply chain vulnerabilities? We've certainly seen plenty of those across industries recently. How does that affect AMAT?
Indeed. The manufacturing of this incredibly complex semiconductor equipment relies on an equally complex global supply chain for literally thousands of specialized components, subsystems, and materials. As was clearly demonstrated during the post-pandemic period, disruptions anywhere within this intricate supply chain can create significant challenges. Shortages of critical parts or logistical bottlenecks getting things shipped around the world can constrain AMAT's ability to actually build and ship its systems even if they have orders. This can prevent them from fully meeting customer demand and directly impact revenue recognition in a given quarter. It's a constant operational challenge.
Okay, so a number of significant risks to keep an eye on. For anyone looking at this company now, perhaps as an investment, how should they think about its valuation? What kind of framework does the report suggest for assessing its current stock price?
Right. This part of the analysis provides a framework for evaluating AMAT's stock, primarily using historical valuation multiples and comparisons to its peers. It's important to stress again, this is not intended as a price target or any kind of investment recommendation, but more as a way to understand its current valuation context. And analyzing AMAT's valuation multiples over time really reveals the significant impact that the semiconductor cycle has on investor sentiment and, consequently, the stock price.
What about their price to earnings, or PE, ratio? How has that typically behaved?
Well, the company's trailing PE ratio has shown considerable fluctuation, as you might expect. During periods of industry pessimism or downturns, its PE has contracted significantly, sometimes into the low double digits. The report cites a low of around 10.8x back in 2018. Conversely, during strong upcycles and periods of high growth expectations, like we might be in now for AI, the multiple has expanded considerably, often into the mid-20s or even higher.
And where is it trading now relative to that history?
Currently, its trailing PE ratio is sitting somewhere around 22 to 24 times earnings. That's notably above its 10-year historical average, which is closer to 18x. So what this suggests is that the market is already pricing in a sustained period of strong earnings growth going forward, largely predicated on that transformative impact of AI driving semiconductor demand for years to come. Other multiples like EV to EBITDA, currently around 16.5x, price to free cash flow, and EV to sales also generally show a similar pattern of trading above their historical averages right now.
Okay, so trading at a premium to its history. How does its valuation compare to its peer group, those other WFE titans we discussed? Is it expensive or cheap relative to them?
Yeah, benchmarking AMAT's valuation against its direct competitors in the WFE oligopoly is crucial for understanding its relative positioning. And the valuation hierarchy within the WFE sector tends to be relatively consistent over time. ASML, because of its EUV monopoly, typically commands the highest valuation multiples. The report shows a PE around 27.6x and EV/EBITDA near 22.4x. That premium is generally seen as justified by its unique strategic position. KLA Corporation, with its dominance in process control, also tends to trade at a premium to AMAT, maybe a PE over 30x, and EV/EBITDA around 28x, reflecting its very high market share, over 50%, and strong margins in its specialized segment.
Okay, so AMAT usually trades a bit lower than those two clear leaders in their niches. How does it stack up against its most direct broadline rival, Lam Research?
Right. Applied Materials valuation may be a PD around 21.9x and a EBITDA of 16.5x in the report's data is most comparable to that of its closest rival, Lam Research. Lam's multiples might be slightly higher currently, PE 27.6, EBITDA 22.0, but they often trade within a similar valuation range. Sometimes AMAT commands a slight premium due to its broader portfolio and that large, stable services business. Other times, Lam might trade higher based on specific technology wins or perceived momentum in memory. Tokyo Electron's multiples, PE 22.7, EBITDA 15.3, are also generally in a similar ballpark to AMAT and Lam.
Is there potential then for AMAT to maybe close that valuation gap over time with the higher multiple peers like ASML and KLA? What would need to happen?
That's a key question for investors. There is indeed potential for that valuation gap to narrow. This would likely depend heavily on AMAT's successful execution of that integrated solutions strategy we discussed earlier. If the company can clearly demonstrate to the market that its ability to provide these co-optimized multi-step process solutions creates a kind of process flow moat that's just as powerful and defensible as a single product monopoly like ASML's EUV or KLA's process control dominance.
Then the market might value it more highly.
Exactly. If that strategy leads to structurally higher, more resilient margins and more predictable revenue through the cycle, it could justify a fundamental re-rating of AMAT's valuation multiples, potentially bringing them closer over time to those of its more highly valued peers. But they have to prove that integrated moat is real and durable.
That's a compelling argument for potential upside. What about using a sum of the parts or SOTP framework? Can that provide any useful insights here?
A conceptual SOTP analysis can be helpful, yes. It involves trying to value each of AMAT's main business segments separately and then adding them up. For instance, the stable, high-margin, and recurring revenue AGS services business could arguably be valued using a significantly higher multiple, perhaps similar to those applied to high-quality industrial service companies or even some software-as-a-service SaaS companies, given its predictability and profitability. The more cyclical semiconductor systems, SSG and display segments, would then likely be assigned lower multiples, more in line with traditional capital equipment manufacturers that face those market swings.
And what's the insight gained from doing that exercise?
Well, the main insight is to help determine whether the current overall market valuation fully appreciates the significant value of that stable and highly profitable services annuity that's embedded within the company's overall structure. Or is the market just valuing the whole thing based on the more cyclical equipment business? It can highlight potentially hidden value in the AGS segment.
Right. And just to reiterate, how important is it for investors to consider the cyclicality of the industry when looking at these valuation multiples at any single point in time?
It's absolutely critical. Given the pronounced cyclicality of the semiconductor industry, point-in-time valuation multiples can be incredibly misleading. Valuing a company like AMAT at the peak of an upcycle using peak earnings can make it appear deceptively cheap on a PE basis. Conversely, valuing it at the bottom of a downturn using depressed earnings can make it look excessively expensive.
So what's a better approach?
A more appropriate approach, although harder to do precisely, involves trying to use normalized or mid-cycle earnings and cash flows to smooth out those fluctuations and get a better sense of the underlying earning power through a full cycle. And looking back, historically, AMAT has often represented a more attractive long-term investment opportunity when its valuation multiples have contracted significantly, falling to or even below their long-term averages during those periods of broad industry pessimism. Buying when sentiment is low has often worked out well.
So for the listener trying to make sense of it all today, what's the central question they should be asking themselves about AMAT's current valuation, given it's trading above historical norms?
That's right. The current valuation clearly reflects significant market optimism about the company's AI-driven growth prospects. Multiples are trading at a premium to their historical norms. So the central question for any prospective investor today is this. Do the structural improvements in AMAT's business model, particularly the growth and stability of AGS and the potential power of integrated solutions and the undeniable secular strength of the AI trend, fully justify this premium valuation? Or alternatively, would a greater margin of safety be required to adequately compensate for those inherent cyclical risks and the complex geopolitical risks, especially around China, that still exist? That's the judgment call.
That's a great question to leave listeners pondering. Okay, finally, let's talk about the people behind these incredibly complex machines. Management quality and corporate strategy. How critical is the quality and experience of AMAT's leadership team in this incredibly demanding industry?
Oh, the quality and experience of a company's leadership team are absolutely critical, intangible assets, maybe even more so in an industry as complex, capital-intensive, and cyclical as semiconductors. You need steady hands at the wheel. And Applied Materials is currently led by a very seasoned team of industry veterans who have a strong track record of execution through various industry phases.
Tell us a bit about the CEO, Gary Dickerson. He's been there a while, right?
Yes, Gary Dickerson has served as CEO since 2013, so over a decade now, and his tenure has been truly transformative for the company. Under his leadership, Applied's revenue has more than tripled, and the company has consistently achieved new records for profitability and cash flow. He's a highly respected industry leader with over 35 years of experience. Before AMAT, he was CEO of Varian Semiconductor Equipment, which AMAT acquired, and before that, he was president and COO of KLA Tencor, another one of the Big Five. So he has this unique, holistic perspective on the entire WFE ecosystem from different angles.
That's deep experience. And the rest of the executive team, any standouts?
The senior leadership team is similarly composed of individuals with really deep industry roots. The CFO, Bryce Hill, is a 25-year veteran of Intel, where he held very senior finance and operational roles, including CFO and COO of Intel's massive technology systems and core engineering group. So he understands chip manufacturing from the customer side. And their CTO, Dr. Omkaram Nalamasu, is a world-renowned expert in material science with extensive leadership experience from the legendary Bell Laboratories. He brings deep technical credibility.
So, real industry heavyweights.
Absolutely. This collective wisdom, forged over multiple semiconductor cycles at different industry-leading companies, is a crucial asset. It informs the company's disciplined capital allocation strategy, its prudent balance sheet management, and its unwavering commitment to long-term R&D investment, even when times get tough. This provides a higher degree of confidence in the company's ability to navigate future volatility and make strategically sound decisions for the long haul.
It sounds like they have a very clear and consistent strategic vision guiding those decisions.
They really do. Management has consistently articulated a clear vision that's centered on positioning AMAT as the leader in materials engineering, specifically to enable the industry's most important and difficult technology inflections, like the ones driven by AI. The core strategy isn't just about building the best individual tools in isolation. It's about providing those unique, co-optimized and integrated solutions that solve their customers' most complex, multi-step manufacturing problems.
And how are they executing against that vision? Are there tangible examples?
Yes, their execution seems pretty tangible. You can point to strategic investments like that multi-billion-dollar commitment to the EPIC R&D Center. That's a very concrete manifestation of their vision for high-velocity collaborative innovation with customers. Also, strategic moves like the investment in BE Semiconductor to strengthen their position in hybrid bonding assembly demonstrate a forward-looking approach to capturing value across the entire manufacturing process, from the front-end wafer processing right through to the advanced packaging stage.
And how transparent are they with the market? How's their track record on financial guidance?
Based on analysis of their recent quarterly earnings calls and financial reports, they appear to maintain a high degree of transparency and have a strong track record of guidance accuracy. Management typically provides detailed financial outlooks for each of its business segments. And importantly, they seem to openly discuss challenges and headwinds when they arise, such as the specific impacts of China trade restrictions or shifts they're seeing in customer investment timing. They don't seem to shy away from the tough questions. And the fact that the company has a consistent history of meeting or often exceeding its consensus earnings per share, EPS estimates, helps build credibility with the investment community over time.
Okay. And quickly, corporate governance. Anything notable there?
Corporate governance practices appear generally well aligned with shareholder interests. Insider ownership is around 0.26%, which is fairly typical for a large-cap company of this size. The board is composed of individuals with diverse backgrounds and relevant industry or financial experience. No major red flags seem apparent from the report.
Okay, good. Finally, let's circle back to their capital allocation and shareholder returns, maybe in a bit more detail. How disciplined is their strategy for using that strong free cash flow they generate?
They adhere to a very clear and disciplined capital allocation strategy. The priorities are straightforward. First, fund organic growth and innovation R&D capacity expansion like EPIC. Then, consistently return a substantial portion of the remaining free cash flow to shareholders, primarily through dividends and share repurchases.
They have a strong dividend policy. You mentioned increases.
Yes, they've demonstrated a firm commitment to growing their dividend payout over time. They've increased the dividend for 8 consecutive years now. Over the past 10 fiscal years, the dividend per share has grown at a compound annual rate of roughly 15%. And just recently, in March 2025, the company announced another 15% increase in its quarterly dividend.
And is that dividend safe?
It appears very safe. The dividend is well supported by earnings, with a conservative payout ratio around 19.4%. That means they're only paying out less than 20% of their earnings as dividends, leaving plenty of cushion and significant room for future growth in the payout.
And share repurchases seem to be the primary mechanism for returning capital. How aggressive are they there?
Absolutely. Share repurchases are the main lever. And Applied Materials has been an aggressive and opportunistic buyer of its own stock, especially when they feel it's undervalued. The board of directors has consistently authorized very large-scale repurchase programs. They approved a new $10 billion share repurchase authorization just in March 2025. As of the end of the second quarter of fiscal 2025, they had approximately $15.9 billion remaining under their total repurchase authorizations. That's a massive amount available.
$15 billion remaining. And are they actually using it?
Oh yes, this isn't just passive authorization. The company actively executes on it. They repurchased $1.67 billion worth of their own shares in the second quarter of 2025 alone. And for the full fiscal year 2024, they bought back $3.8 billion worth. The sheer scale of these programs really underscores a long-term strategic commitment to returning capital. It also acts as a powerful signal of management's belief that the stock is intrinsically undervalued at current levels, and it can provide consistent valuation support in the market.
So their capital deployment overall seems very effective, focused on growth and shareholder returns.
Precisely. Their capital expenditures are strategically focused on supporting long-term growth, primarily through those investments in R&D infrastructure like the EPIC Center and expanding their technological capabilities. And their historical performance demonstrates highly effective capital deployment overall, evidenced by strong return on invested capital, ROIC metrics, and that high profitability rank of 10 out of 10 cited from sources like GuruFocus. They seem to be good stewards of capital.
Okay, fantastic. We've covered a huge amount of ground today. We've navigated the incredibly complex world of semiconductor manufacturing, really uncovering Applied Materials' critical role as a truly indispensable enabler of this AI supercycle. We've seen how their broad portfolio, that resilient recurring services business, and their relentless focus on innovation create a powerful competitive moat, which is clearly evidenced by their robust financial performance.
Absolutely. So hopefully you, the listener, now have a much deeper understanding of the powerful forces shaping this vital industry, AMAT's unique positioning within it, and the key financial and therapeutic factors you'd need to consider when evaluating its future prospects.
And just to leave you with a final thought, as the world demands ever more complex, powerful, and efficient chips for AI and whatever comes next, AMAT's ability to potentially pre-validate entire manufacturing recipes at its new EPIC Center, in deep collaboration with customers, that could truly shift the industry power dynamic even further. What does it really mean for technological progress when the tools and the optimized recipe become almost inseparable? And who truly owns the future of innovation then? Something to think about.